How did you do the due diligence in the past when you started, and how it has changed now because you are so experienced now?
Great. That's a great question, Vinky. I will say experience and looking at a lot of deals will bring a lot of knowledge and honestly, a lot of wisdom. It comes from doing deals. The reality is that when you're first getting started, you're very, very, very likely to have what they call analysis paralysis. And you want to look at every little detail. You want to make sure every I is dotted in the PPM, every T is crossed. You have a question about every number you see on a spreadsheet. But the reality is that at some point you have to take a leap of faith, and there is no such thing as a perfect deal.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. Today, I have a very good friend, Brian Alfaro, with me. Welcome, Brian, to the Real
Thank
Estate Vibe Show.
Yeah, thanks for the opportunity to talk to your amazing audience, Mika. We've known each other now for a few years, so surprising we haven't done this more often, but that's okay. Here I am.
All right, welcome. I'm so excited that you're here today. So, a little bit about Brian. Brian is the Director of Investor Relations at Headway Capital. Brian's extensive background in operations, marketing, and brand development in high volume hospitality concepts play a role in ensuring investing partners receive a first class experience. We all invest, but how much attention do we pay to red flags? And I think that's what we're going to be talking about today because I picked the topic. Actually, Brian gave me this topic. He said, this is an interesting topic that we should be talking about, the passive investing red flags. So, like I mentioned, everybody invests. Do we truly aware like what's going on? What are the warning signs? What are the red flags? And understanding these red flags are crucial. It helps us, the investors, or our investors avoid the pitfalls and make more informed and secure investment decisions. So, and let's start, Brian, with the first question. Just like the basics on the passive investing, how exactly the passive investing works and how it differs from the active investing.
Yeah, that's a great question, Vinky. And I think that's a great place to start because some of your audience might not know the difference. And maybe it's your first time hearing this term. If you're here, you're interested in investing in real estate, you probably like the idea of generating cash flow or what I like to call mailbox money, where there's a couple ways you can do that. One of those ways is being an active investor, and the other one's being a passive investor. And the difference between the two is really about how hands-on you're willing to be. Somebody who is an active investor is looking for their own deals, they're underwriting deals, they're talking to realtors and brokers, they're talking to lenders, they might be talking to equity partners, whether they're doing JV deals or syndications, and then they're putting the deal together when there finally is something that's lucrative enough for everybody to partner on. But really, the most important part, because that's kind of the early heavy lift, really the most important part is the active investor handles the day-to-day responsibilities of making sure the business plan is executed. And that is the hard part, in my opinion. A lot of people can find a deal. A lot of people are even good at raising money, but actually executing the business plan, operating the property, especially if you're investing in something that's got a lot of moving pieces, whether it's multifamily or retail, where there's anything that has people involved, as I like to say, has a lot of moving parts. That can be very challenging. So that's the active side. There's obviously a lot of upside there. There's a lot of money to be made, but it requires some seasonality, some experience managing businesses, and it also requires, more importantly, a time commitment. Because if you're managing your own money, if you're doing your own deals, or you're managing other people's money, you don't want to be learning on someone else's dime, and you want to make sure you make use of that time very wisely. So it's challenging, not impossible, but challenging to do it on a part-time basis. Passive investing, on the other hand, is kind of the opposite, to be honest. Passive investing is essentially where you find somebody who is an active investor, which is what I was just describing, and you partner with them by providing your capital to get that deal done. And in return for that, you get a few benefits. A lot of the same benefits you get as an active investor, just on a less active space and in a different type capacity. So you get cash flow from distributions that are paid, whether they be monthly, quarterly, however the deal is sort of structured. And obviously, every deal is different. You get the equity appreciation, meaning you put your money in, and over the life cycle of the deal, it grows as property values go up, as the NOI is pushed up, and hopefully market conditions are favorable. You get the tax benefits that come along through cost segregation and depreciation, and you get all these things without having to really lift a finger. You just have to do your due diligence on the front end, which is what we're going to talk a little bit more about today. Is what are those red flags? I mean, we have five that we could talk about here today, but I mean, I could talk about 7, 10, 20. There's so many. It kind of depends on your situation, but what are those red flags you need to be looking for if you're a passive investor to make sure that you don't partner with the wrong active investor or you don't partner in the wrong deal? So those are the two primary differences between active and passive investor.
So tell me, how did you start as an active investor or passive investor? What does your journey look like in real estate?
Yeah, I'll try to give you the short version. Started off as an active investor. Part of the reason was because I was much younger at the time. I'm not super old, but I'm 35 years old now at the time. This was about 7 years ago. So I was about 27, 28. I was doing pretty well for myself. I had a good job. My wife and I had just gotten married, and I had some bandwidth. And by bandwidth, I mean time to be an active investor. So I started off by just like most people do, is investing in residential real estate, buying houses, doing some fix and flips, buying some rental properties. I did some wholesale transactions and was trying to figure out which hat I really enjoyed wearing the most on the residential side. And the goal was to get to commercial eventually. Well, I found out very quickly I didn't like any of the hats on the residential side. And I said, you know what? I think this was about 4 years ago now. So I was 30, still 30 years old at the time. And I told my wife, if we're going to take some risks and do something, now's the time. We don't have kids yet. Yeah, we have a house, but we feel like we're young enough. My wife's a few years younger than I, that if for some reason we started in the real estate space and let's just say a devastating thing happened and we lost everything, we were young enough to sort of hit the reset button. You know, it's not like I was approaching retirement and, you know, had a pile of money. And if I lost it all, it would be devastating to me. So went all in on multifamily in 2020, did several deals with some great partners and really grew into the role I sit in now here at Headway, which is the director of investor relations role. So I talk to all of our prospective investors, all of our current investors, all of our fund managers and partners that work with us. And yeah, so now I do passively invest in the projects that we put on the table for our investors. I've done that in the past as well when I was getting started. So I like to say I started off as both an active and a passive investor, but the intention right now, just that where I'm at in life, I'm a full-time real estate entrepreneur, a full-time real estate investor. So I am on the active side.
Right. And you said very good thing. You said you spoke to your wife and you said, let's take the risk.
Hmm.
And you said, what could go wrong? We can reset the button. I love that.
Yeah,
Because
it's true.
a lot of people, they don't think like that because their limiting beliefs, maybe their own set barriers, or all had added to their personality as they're
Sure.
bringing up. So people don't like to take those kind of risks. They don't want to lose everything or even anything. They wanted to stay on the sidelines. So I wanted to ask you, where did you or how did you get that mindset? And you're like, okay, I'm all in, all or nothing. Let me take a shot. Because sometimes, when you do these kind of things, you are taking a big jump
Sure.
and
Sure.
that takes you to the next level. So talk about that.
Yeah, I mean, for me personally, you know, I mentioned I did have an entrepreneurial mindset, and I'm kind of wired like an entrepreneur, whatever that means. What that means is I have a higher risk tolerance than probably the average person. But also I have a strong why. And I think anytime you're getting into anything, whether it's a new business, buying, you know, an existing business, starting a business, investing in real estate, you have to understand why you're doing it. And at the end of the day, of course, there's financial, upside, right? We're all here to make money. We're not buying buildings because it makes us feel good, right? Like we're here to make money. Let's get that out of the table. But what else are we here for? And what's our really big motivating factor? And for me, I'm a lot of the first generation for just things on my family, and everybody's story is different, right? But for me, I was the first person in my family to go to college. That was a big deal. I was the first person in my family to start a small business. That was a big deal. I'm the first person in my family on both sides to be a real estate investor, which is a big deal. So for me personally, my why at the time when I was getting started was always about trying to change my family tree in a positive way. Because I personally believe that, we're put on this earth, whether you're religious or spiritual, doesn't really matter. We're put on this earth, right? We're here. We have to enjoy the time that we're here because we don't know how long we're going to be here. It could be much shorter than we think it's going to be. And the question I always ask myself is, at my funeral or your obituary, like what are people saying about you? What are they thinking about you? And then also, what type of positive impact did you have on your family? Because these things that we do, what we don't realize is they can be felt for generations, right? It's not just your kids, but it's like your kids' kids and your kids' kids' kids, right? So it's the mindset that you have and you instill in the people around you, whether they're friends, families, business partners, your kids, of course. It's just so powerful. And it's really, I think, more powerful than money, right? I mean, if I left $10 million for my kid, 500 years from now, that money would probably be gone, right? It's money. It doesn't really have any value, so to speak. We have a fiat currency, right? But a mindset, a lifestyle, a way of doing business, a way of thinking about progress and self-improvement. I mean, that's something I think can have a domino effect on your family for generations to come. So that was my big why. I was married at the time, my wife, I wanted to change our family tree. I wanted to set us up for success. And that's what allowed me to sort of take that risk, to do something big, do something bold, sort of go all in, so to speak. Because to be honest, the way I was looking at it was I didn't really have a lot to lose. What's the worst case scenario if you start investing in real estate? It doesn't matter what, wholesaling, single family, retail, whatever, right? What's the worst case scenario? You go back to work, right? And how bad is that really? The reality is that most people are already living their worst case scenario. They work at a job, right? They have a W-2 and they wish they could quit and be a real estate investor or invest on the side in real estate. So if you're already living your worst case scenario, why not just do it, right? Why not go all in? And if it all falls apart, you just jump right back into your job. There's plenty of jobs to go around.
That's so true. And you said very good things, not even one, like many. So I'm going to highlight few of them.
Sure.
First, you said the why. Why is very important. Why drives you to get to your goals. And the other thing is you got to have a vision.
Mm-hmm.
That's very important. Vision is like your address, where you want to be. 5 years from now, 10 years from now, 20 years from now, the vision has to be clear. And the most important thing is that aligns with why is your mission, your existence, your being, why you're here. So you answer all the questions for yourself or give the right answers to yourself and kind of pave your path to where you are today. That help you accelerate your growth, I would say, kudos to that. I really like that. And now let's come back to our investing now. Because we have all kind of investors, active investors, passive investors. And we picked the topic today to talk about some of the red flags. A lot of the investors, sometimes they are not aware of everything because they see the returns like 20% return, 30%
Sure.
return, 50% return. They're like, boom, oh my God, this is much better than the stock market. I'm getting only 7%, 10% average. Let me go ahead and put my money. And let's talk about the process there, that what red flags that people should be paying attention to, number one, and the due diligence, obviously, what steps they should take to, even dig deeper than just the numbers, right? So I think your company and you have already thought about the 5 red flags. Let's talk about those first.
Yeah, there's so many, and I'll try to keep this within our time balance because I think we talked for 2 hours about this. We'll have to do separate podcasts, but there's a lot to think about. So the first one that I like to talk about that I think often gets overlooked because of the things you just mentioned, and that's the shiny numbers, right? We see the high pref and the 20% average return, the 2.1, 2.2 multiple, and you see the pretty pictures. And that's kind of my job is I make it things look pretty on the marketing side, right? But you got to dig deeper than that because if you just get enamored by the numbers, it's not really a full picture of how much risk is in this deal and if the people that are actually doing it are qualified. So the first thing that I like to ask myself is exactly what I just said is who is doing this? Who's putting this deal together and who is the operator, right? So I like to say number one is really the operator's resume, right? What have they done in the past that shows that they have the capacity to do it again? And if they've never done this before, and that's not necessarily a red flag. Some people say, "Oh, don't invest with first-time investors." Well, we were all first-time investors at some point, and if nobody ever invested with you, Vinky, or nobody invested with me, it's been 4 years, we'd still be sitting here, just talking about nothing, right? So you have to give people an opportunity. We've all been given shots at life. So I don't like to say it's necessarily a red flag that somebody's new, but you still have to look at somebody's resume. So what does that even mean, looking at the resume? So first thing I like to look for is education, right? Are they educated? It's not necessarily a deal breaker if they didn't go to college or something like that, but I kind of want to know, do they have a bachelor's degree? Do they have a master's degree? What is it? And do they have a successful background in business? That's a really big one for me because I think people think about real estate and they think about the sticks and the bricks, right? The buildings. But what they forget to real or fail to realize, what they forget is that you're not buying just real estate. You're actually buying a business. It has employees, it has income, it has expenses, it has taxes, it has insurance. Well, that sure as hell sounds like a business to me, right? So if you have somebody buying a building and putting a project together and they don't know how to manage a business, you're going to have some problems. And as I mentioned earlier, I don't like, learning on other people's dime. And I don't usually like when people are learning on my dime. It doesn't mean it's guaranteed to fail, but it's a red flag. It's something I look for to see if they have experience in business. And the other thing with the resume that I'm looking for as well is their experience in market cycles. So if they are an experienced investor in real estate in particular, I'm curious what type of trials and tribulations that they've seen that they're willing to be honest about. Because here's the reality, Vinky, and I know you know this, we've been in this long enough, and not every deal is going to go perfect, right? And if you're getting into real estate and you expect every deal to be perfect, then you probably just shouldn't invest. Just go ahead and turn off the podcast right now, right? Because it's just not the reality, right? If you were to invest in 100 stocks and 99 of them made money, you'd be super happy. If you were to invest in 100 real estate deals and 99 of them made money, you'd be super happy. Well, guess what? At least one of them is going to fail in that situation. A 99% hit rate. The reality is it's a little lower than that. It's probably like 90%, maybe 95%, right? It doesn't mean you're going to lose money necessarily. Nobody wants to lose money, but they might not be that slam dunk or that home run that you're thinking about. And there may be way more challenges getting there than you thought they were going to get. Maybe you thought it was a 2 or 3 year hold and it ends up being a 5 or 6. Maybe you thought it was a 25% return and ends up being a 19% return. Well, it's still pretty good, right? But you have to understand like those market cycles that we have can cause those challenges, right? So what type of stuff has the operator seen? Have they been through a recession before? Or, were they involved in 2008? If not, that's okay. A lot of operators weren't. What type of other business challenges have they felt? Maybe they were around during COVID. How did they weather that storm during COVID, collecting rents when people didn't have jobs? What are they doing right now when the interest rate environment is really high and people have a high amount of credit card debt and they're struggling and unemployment's going up? How are they sort of managing their portfolio? Are they offering concessions to keep occupancy up, to keep income coming in? How are they managing expenses? There's a lot of questions you want to ask for somebody. And if they're experienced in business and they're experienced managing things through market cycles, they're going to be proactive versus reactive, which I think is a big difference. And those are, I would say, the big things I like to talk about when it comes to the operator's resume.
Those are all really good. So in nutshell, what you're saying is education is really important. I would say that too. That should be part of the due diligence, kind of to understand the person who you're trying to invest with, because not necessarily it has to be 100% real estate experience, but any experience in their life, if they have succeeded doing that, whether it's an IT, doctor, engineer,
Right.
whatever they did in their life, and whatever the path they pick, if they excelled in that, they will excel in whatever they're doing right now too, because that's their true track record, not necessarily all the real estate deals. So that's very important. And the other thing you mentioned is, how they respond to the failures. I'm
Mhm.
going to you said the market downturns, but I'm going to say failures because because howsoever they're responding to the failures, that's how they're going to look at the market downturns in the real
Mhm.
estate language. Because if they know how to be proactive versus reactive using your language, again, they're going to succeed. When you're investing in real estate, you're kind of betting on a jockey.
Yep.
That's the name of the game. And if the jockey is good, they're going to make the bad deal into a good deal.
Mhm.
And you always have to remember that. So now let's look at the horse itself, the deal. Deal has this whole spectrum of red flags as well.
Yep.
The market, the population, or job, or whatever, the sub-region market, all those things. So if you can talk about that a little bit,
Sure.
as a passive investor, if I wanted to invest in somebody's deal, what are some of the key things that I should be paying attention to?
Absolutely. So I think these are crucial. So once you get past the operator's resume, understanding the deal specifics themselves are crucial because again, you'll get distracted by the numbers. So the first thing, and this is a test, technically number two on the list that I look for, is the location. I think location is so important. And again, it sounds like common sense. There's an old saying in real estate, location, location, location. And it's like, what are the three most important things in real estate? Location, location, location. It's so true because you could have the nicest property in the worst area and it would probably not go very well, right? And then you could have a kind of average property in a great area and you could do really well with it if you're able to clean it up and turn it around and get the right residents in it, right? Location is so important. So there's questions you have to ask yourself, like, well, and not just like the address, but is this a primary market, a secondary market, or is this a tertiary market? If you've never heard that term before, essentially what we're looking for is to find out how big is the city that this property's in, because that has a drastic impact on a bunch of things. One are jobs, right? So location and jobs go hand in hand. If you're in a big city, or great area, there's probably a lot of jobs already, and there's probably a high likelihood of job creation in the future. Companies are moving there, new factories are open, new restaurants are open. A lot of synergies go when the economy is getting picked up. Rising tide lifts all boats, right? And when that happens, population tends to grow up. When there's more people, that means there's more renters. When there's more renters, that's good for your occupancy, right? There's a high likelihood you're able to increase your rents in those types of situations. So the location of the market, understanding if it's primary, secondary, tertiary is really important too. When it also comes to the exit strategy, I've seen this in the past where some people get enamored by how cheap a property might be. They're like, oh man, we're buying this thing at 45K a door. And I'm like, where is it? And it's in a city I've never heard of, in some place I've never heard of. Right. And I'm like, well, there's a reason you're paying that little. And there's a reason it's a seven cap or an eight cap or a nine cap. And I'm like, that sounds super sexy on paper to get something at a smoking hot deal relative to maybe a more attractive asset. But what people forget to realize is there's a reason it's cheap. I always say you get what you pay for. And the big thing that people forget to think about is the exit. When you're selling a property 3 years, 5 years from now, in an unattractive market in an area that no one's ever heard of, there are way less buyers, right? There are way less people that are interested in investing 4 hours outside of Houston in a city I don't even know exists versus investing right in the heart of Houston, Texas, right? Or wherever your core city is. So that's a really important factor as well. And then in the location, there are different classifications, right? Is this an A market, a B market, a C market, or D market, or A class, B class, C class, D class? Because you can, again, as I mentioned, you can have a B class property in an A class area and it's going to perform really well. But if you have a B class property in a D class area that has a lot of crime, has a lot of violence, has bad schools, has a lot, things like crime and drugs and things like that, it's not going to perform really well, even though it might be a really nice, solid B class asset. So all these things are really important, and you cannot overlook location before you even get into the business details.
So when you're checking the location as a passive investor, what are some of the sites that people can go to or where they can check the location? Any guidance there?
Yeah, that's a good question. If you just type in a city's name in Google, the first thing I like to look at is what's the population, right? Because population is usually pretty telling. And there's kind of a baseline. I mean, there's a bunch of really smart people that are way smarter than me, like in the data space. Like Neil Bawa is a really popular guy who's really data centric, right? And he talks about trying to not invest in markets that don't have at least 250,000 people or more in population. Is that a hard and fast rule? No, but there's probably some sort of data to that where if you invest in markets that are too small, you're going to have issues with renting units. You're going to have issues with population growth. You're going to have issues with job creation. You're not going to have a lot of success being able to raise your rent. So that's a big thing. Just go to Google. If you're investing in, Houston, you type in Houston MSA population, or you type in a submarket of that population. So that's a big one. The other one you can do is just type in, again, just Google is your friend, type in the city that you're investing in, and then type in average household income. That's a big one for me too, right? Where you'll be able to find, okay, we have a business plan here. We're planning on raising rents. We're planning on renovating the units. Can this market actually absorb this type of rent growth? Maybe the answer is no. Maybe the income there is not very good, right? Now we have a bunch of real estate stuff like, Vinky, we have CoStar and different things like that. But I'm talking about like to the average person, the average passive investor that's not paying thousands and thousands of dollars a month or talking to brokers to get access to CoStar data. Just using the internet and Google as your best friend, looking at average household income, looking at population, and looking at demographics. That's my best answer. I don't have like one little go-to site.
Yeah, no, this is a good answer. And then plus, when we bring the deal to the investors, we do our own due diligence. Like,
Right.
for example, for me, I have 200 or about more than 200, close to 300 points that I use for the due diligence and make sure the deal is solid before I bring it to my investors. So we
Right.
do all that too. But if you wanted to do like a little bit more check on top of what is already done, you're welcome to do so. And ChatGPT these days, super and easy,
Yep.
like friend beside Google, your ChatGPT friend as well. So let me ask you that. Sometimes some investors they're quite concerned about the fees, and they ask this question all the time. Like what are some of the hidden fees that we do not know about? And then transparency is like really important for the investors. And I think most of the sponsors, they do that. They try to be very, very transparent and try to show them kind of black and white picture to investors all the time. What could be some of the red flags in that area that the investors should be aware of, that they need to be paying more attention to the numbers? But
Sure.
the thing is, I'm going to say one more thing over here. The investors should understand that, like you said earlier, we are here to make money. Everybody wants to make money. So if there's a fees sponsor is charging, they want it to get paid for all the effort that they're doing from conception to completion, because there's a lot involved. So that fees is okay. But other than that, there's any specific red flags for the investors?
That's a good question. And I like, Vicky, the way you started this conversation because I like to lay a foundation about this conversation before I make some statement or express my opinion. And this is, again, just my opinion, but I personally, and this is just me speaking, I like to invest with companies, right? Not necessarily just people. And what does that even mean, right? I want to invest with somebody who has, people on their staff to help, somebody who has, HR, somebody who's in finance, there's all these different, umbrellas that within a company, right? And what does it take to operate a serious company so that you, as a passive investor, have awesome customer service? You love investing with this group. It's like the best thing ever. Maybe the deals aren't always great, but the experience is good, right? It requires people. And what do people need when they work for you? They need money. You have a payroll, right? You have an office. You have all these expenses, insurance, right? When you have a company, well, that costs money. And in order to fund those types of projects, the sponsor has to charge some fees, right? So my mindset is I'm okay with paying fees that are disclosed, that I see, that are transparent, that make sense, that are in line with where the market's at, if I'm getting something in return for it. And usually what I'm looking for is a high level of customer service, right? If I know I'm investing with a sponsor who's been around for 10 or 15 years and has 200 employees, well, yeah, I expect them to be charging some fees. They got a lot of mouths to feed, right? If I'm investing with one guy who just started doing this 3 months ago and it's his first deal, and his pitch to me is my deal doesn't have any fees, well, I actually get kind of concerned by that because he's not making any money. Nobody likes doing anything for free. And how is this going to support any type of ecosystem if the deal has trouble and needs some people to kind of step in and have hands? So that's where I'm at when it comes to fees. I think fees have a place and they're important if somebody's trying to grow and you want to receive good customer service. But with that being said, I will say that there is a such thing as too many fees, right? And there is a such thing as kind of feeing the deal to death, or so to speak, where maybe I like to see deals that personally are incentivized on the back end, have some fees at the front to make sure that the company's growing, reimbursing the sponsor, making sure they're getting something for putting the deal together. But I like to see when the sponsors are incentivized more by performance than necessarily just like a huge acquisition fee at the end, at the beginning, 3, 4, 5%, something crazy. And then they get nothing at the end. Well, they're kind of incentivized just to do the deal, right? They're not necessarily incentivized to make sure the deal performs. So I like to see a well balanced. So typically, I'm just kind of in general what I'm seeing on fees in the market, depending on the size of the deal. Usually you're seeing like a 1 to 3% acquisition fee that's going to be on the front. That's the sponsor's compensation for putting the deal together, all the stuff that kind of goes along with that, right? Then there's usually going to be some sort of asset management fee, which again, if you're working with a company that has employees, that fund doesn't go into the sponsor's pocket, doesn't go into my pocket. It helps cover payroll and different things like that that go along with making sure the deal is actually performing. And then there's usually on top of that, depending on the sponsor, sometimes there can be refinancing fees or disposition fees. Sometimes there can be personal guarantee fees. Those are the ones that I always kind of note with an asterisk, that I have to really feel like there's justification for me paying that fee. And I gotta, if there is that fee there and the deal still pencils and the deal makes sense and the returns are still there and the track record of the sponsor makes sense and I still get my returns, well, I don't care if there's a refinance fee, and I don't care if there's an exit fee, and I don't care if there's a a KP, key principal, somebody for signing on the loan fee. As long as the deal still pencils, I'm happy to pay those fees. But what I don't want to do is pay a bunch of fees to somebody who's not qualified to demand those fees.
And plus, you said a very good thing, like people are in the deal for experience,
Hmm.
and then I would say the money is a byproduct of our efforts, basically. But at the same time, everybody's doing something for that particular experience. And if they're getting that experience, whether, let's talk about the real estate investing, for example, if they're getting all the experience, the good, the bad, and ugly from 10 feet away without lifting a finger, I don't think there should be any issues about that, because people who are taking the deal from the conception to completion, there's a lot involved in that. There's a lot of moving parts, and keeping track of everything, I think there's require much more effort from the team, and the fees that's being charged to compensate all that, right? And
Right.
if the general partnership team is happy, they're going to be working hard to even get the better numbers for the investors. How about if you share your experience, how did you do the due diligence in the past when you started, and how it has changed now because you are so experienced now?
Great. That's a great question, Vinky. I will say experience and looking at a lot of deals will bring a lot of knowledge and honestly, a lot of wisdom. It comes from doing deals. The reality is that when you're first getting started, you're very, very, very likely to have what they call analysis paralysis. And you want to look at every little detail. You want to make sure every I is dotted in the PPM, every T is crossed. You have a question about every number you see on a spreadsheet. But the reality is that at some point you have to take a leap of faith, and there is no such thing as a perfect deal, right? So once you get over that hump and you start looking at a lot of deals, and then you eventually start actually investing in a lot of deals, the way you look at deals changes drastically, because I can look at a deal in a matter of minutes, usually like 60 seconds or less. It makes me decide if I want to, maybe 2 minutes or less, if I want to keep going. And then there's a kind of like some things that I go, okay, I'm going to keep going. Okay, I'm going to keep going. One is of course a sponsor. People are known in our industry. It's a small industry, right? If somebody has a good reputation, doesn't mean every deal they do is a slam dunk or a home run, but if they have a good reputation, I'm interested, right? Where's the deal at? Okay, it's in a market I've heard of. I've heard good things. I did a quick research on population and I know there's job growth there because I read a lot of news and headlines. Okay, I like that. And then I want to see just kind of quick and overview things. I want to see what are they buying the property at? What's the entry cap versus what's the exit cap, right? So what are you planning on selling this thing compared to where the market's at and compared to where you're buying it now? Is there enough arbitrage there, or are they going the wrong way? Are they buying it at a 5 cap and assuming they're going to sell it at a 4 cap? I'm out. Sign, control alt delete, sign off, restart. I'm not interested, right? So really simple things like that. And then I'm also looking at what the business plan is. So there's kind of, I hate to call it common sense, but there's kind of a, things that make sense and things that don't make sense, right? So if you're looking at something and they're like, yeah, we're going to get $200 rent growth, and you look at how they're planning on getting there, it's like, yeah, we're going to add, smart thermostats and new carpet. I'm like, well, that's not enough to get $200 in rent growth, right? There probably needs to be some more substantial renovations. So if you've got a $3,000 a unit budget, when I know a baseline renovation in that market is more like seven, and you want $200 in rent growth, I'm out. And again, that comes with experience. I've looked at thousands of deals. I know what a $5,000, a $7,000, a $10,000 renovation looks like, and I'll know if you'll be able to get that rent growth off of there. The third thing I look at, or one of the things I look at, is just where the property's at. I try to only invest in markets I know and understand. So I'll Google the address real quick and I want to see where it's at. Just do Google Maps is amazing. You can drive around virtually and look at the neighborhood. Is there, is it a bad part of town? If I go down a few blocks, what does it look like? If I go back a few blocks, what does it look like? If I go left a few blocks, what does it look like? I'm doing a full 360 to see, is this an area that when people drive by, they even want to be in, right? And then I'm looking at just the overall sort of underwriting assumptions. CapEx spend, entry cap, exit cap, price per door. Again, the more you know the market, you'll be able to really quickly look at something and go, they're paying too much. I can look at something within 30 seconds and go, nope, that's Houston, Texas. That's a C-class property, and they're paying 100 a door. They're out of their mind. I don't even need to look at this, right? I don't care what the business plan is. They're overpaying, because the one thing you can't undo is when you pay too much, right? So, and then the other thing I'm looking for is, does the debt, we didn't talk anything about debt today, but does the debt match the business plan? All right. People are like, oh, I only do fixed rate debt, or I only do floating rate debt. I don't think either or are bad or good. It's about using the right tool for the right business plan, right? So if it's a heavy renovation and there's a lot of risk here and they're not stabilized, they're going to have to use floating rate debt. They're going to have to use bridge debt. Not a problem. Does it have a cap on it, an interest rate cap, so that we don't get exposure to interest rate volatility? How long is the cap for? What are they paying for it? Are there enough cash reserves to buy another cap in case the cap expires if it's a short-term cap? If not, why? Like, there's just like more you kind of go to. I don't just go, oh, nope, not fixed rate debt, not interested. So again, the business plan has to match the debt. So those are just a few kind of things that get me in or out. Again, I'm going through the slide deck really quick.
I think this is like all really golden nuggets right here, whatever you're sharing, These are all the basics. And when you have those down, I don't think you can make wrong decisions. This will help you make the wise decisions. But the only thing that sticks out is analysis paralysis that you said earlier.
Yep.
And that's the major showstopper for any investor. Because even they know everything, they have the self-doubt, like,
Yep.
oh, maybe it's not good. Maybe I do not know enough. So how do you get over that self-doubt or this analysis paralysis? It's like kind of mindset game right there. So what advice do you have for the investors there?
If you have analysis paralysis, I will say eventually you have to take action and just do a deal, right? So that is kind of like, oh, how do you get over it? Well, the way you get over it is by doing a deal. Well, how do you do that? Well, I will say the more you surround yourself with people that are where you want to be, the more likelihood you are to take action, right? So if you're a passive investor or trying to be a passive investor, or you're a sponsor and you're trying to be a capital raiser, a fund manager, whatever hat you're trying to wear in real estate, surround yourself with people that are already where you want to be, right? So find other passive investors that have been very successful. Their wisdom and their guidance is valuable. Their relationships are valuable, and they're going to motivate you. Like, man, that guy, he's making an extra $20,000-$30,000 a year from passive income. I want to be that guy. Well, find guys like that, and it'll motivate you to do the same thing. If you want to be a sponsor, you want to be an active investor, find guys that are where you are, Vinki, where we're at over here at Headway, that are already where you want to be, that are 1 year, 3 year, 5 years, 10 years ahead of you, and get to know those people. So the best way is to have a really strong network, have a bunch of people that are motivating you. And then that's the best way to crush those limiting beliefs. It's just being in the right room with the right people.
That's true. And plus ask questions,
Mhm.
That's very important. The more questions you're going to ask, the more knowledge you're going to gain. Just increase your perception, basically, like you said. Have a better network for yourself, get more knowledge. And when when you have more knowledge, it's going to increase your perception. When you increase your perception, you're creating more better quality experiences for yourself. So that's going to all add to your mindset. and
Right.
it's going to expand. And we all know that once it's expanded, your mind is not going to shrink back.
Right.
So that's going to give you more risk appetite right
Sure.
there. So, gosh, I can keep on talking to you, Brian, but we are out of time. Can you share one more golden nugget with my audience?
Oh man, there's so many. I will say golden nugget for your audience would be ooh, so many good ones. I will say, really dial in your why. I think I know I talked about that a little bit, but it's so cheesy and you'll probably hear it a lot from more experienced guys. And I think that's really important because not only will your why help you get started, but your why will help you push through when things are hard. And trust me, they get really hard. Not everything is rosy. I know you get on YouTube or you get on TikTok or Instagram and you see these short clips of these real estate investors with the nice car and the nice boat and the big house and the beautiful family and like they've got all these luxuries. What they don't tell you is it took them 20 years to build it, right? Or they're if they do, they talk very little about that. So there's a lot of challenges that come along the way, and having a really strong why will help you push through those challenges and remind you why you're doing it in the first place. So sit down, pull out a pen and paper, turn off your phone, get off social media, get off the internet, and just you and a pen and paper and maybe a cup of coffee or something, and really ask yourself, why am I doing this? Why am I even thinking about getting into real estate? Because if you don't have a really strong why and it's just money, I would bet money that you have a very high likelihood of not succeeding and that you probably quit after the first year or two, which is what we see all the time, right? You and Vinky, you and I have been to many conferences together, and you see somebody at a conference and you meet them and they're super excited. They just got the real estate bug, and then you never see them again, right? Because
That's
they fell off the map because they tried, it got hard and they quit. So don't be that guy. You need a strong why.
That's true. I agree on that 100%. You have to have a strong why to do anything in your life because, and plus, real estate is a marathon.
Hmm.
It's a wealth building tool right there, generational wealth. You wanted to leave a legacy. It's not like that. You invest in one deal and you kind of call it quits, It does not work like that. So it's a process. Once you learn it, you kind of repeat it over and over again.
Yep.
So this brings us to our why rapid fire round. I'm going to ask you 5 questions. You're going to answer it in one word or one sentence only. Are you ready?
I'm ready.
All right. You're always ready, Brian. First question. What is one of the most important things that you've learned in your life? And how did your life change after learning it?
I would say serving others, and your life will be more fruitful if you learn to serve people.
I love that answer. Thanks for that. Share one good book that you like to recommend to my audience.
I would say one of my favorite books that I reread is the Seven Habits of Highly Effective People by Stephen Covey. It's a classic. It's written many, many, many years ago. And to me, anytime you read a book that's 10, 20, 30, 40 years old and it still applies to today, there's a good lesson in there.
That's true. And every time you read it, there's something out of it
Yep.
because it depends upon your mood,
Yep. Yep.
in which your mood you're reading it. So your perception is different. In one word, what does life mean to you?
Um, I would say love.
That's a good answer.
Mhm.
That's really good. There's only 3 things in life: love, happiness, and peace,
There you
right?
go.
If we nail that, we have the best life.
Boom.
So, what is your biggest passion?
Mm. My biggest passion is not here yet. My wife is 8 months pregnant with our first baby girl, so she is going to be my new passion here in a few weeks, depending on when this airs. Maybe she'll be here by then, but I would say right now my biggest passion is back to one of my other answers is just serving others, whether it be my wife or friends or family or business partners.
Congratulations for the baby, first of all. Can't
Thank
wait
you.
to hear you soon. So, if you can turn back in time and talk to your younger self, which could be like when you're 2, because you're so young, what would you tell yourself and why?
Get started now. And I would say that because there's no such thing as too early. There's also no such thing as too late. The best time to start was yesterday. There's no perfect deal. There's no perfect market cycle. There's no perfect circumstance. You can't wait till you have a certain number of dollars in your bank account. You get to a certain age. You serve a certain number of experience. If I could have got out of college at 21, 22 years old and started doing something in real estate and not started 5, 6 years later at 27, 28 years old, I would be 5 or 6 years ahead, right? And be in a much different spot. So I would say just get started. Yep.
Because other than that is like the past or the future. Past is memories, future we do not know, all unknown. The present is now and do it now. I love that answer. So how can people reach out to you?
Yeah, I'd love to talk to anybody who wants to learn more about what we do here at Headway, or wants to get even interested in the active side and learn how I got to where I got to. You can reach out to me at brian@headwaycapital.us. You can also reach out to me on LinkedIn. I'm very active on LinkedIn, love to post good content and engage with people. So just look me up. First name Brian with an I, last name Alfaro, Alfaro. And I would love to chat with you.
Thanks, Brian. I enjoyed talking to you today.
Thanks, Vinki.